Hey everyone, welcome back to Corporate Decoder. Today we're diving into World Kinect Corporation's latest quarterly report, and let me tell you, this one is a bit of a roller coaster. Get ready for some turbulence with asset sales and a shrinking bottom line, but hey, at least the name World Kinect Corporation is kind of cool, right? World Kinect, they're in the business of managing and supplying energy around the globe. Think fuel for planes, ships, and even natural gas for your home. The report covers their performance up to March of 2025, giving us a peek into how they're doing in a pretty volatile energy market. First things first, this is a Form 10Q, meaning it's a quarterly snapshot, not the full year picture. World Kinect is on the hook to file these regularly, so you know they play by the rules. Also, don't get them confused with a shell company, as they are very much not a shell company. They are a real player in the energy sector. The company had about 56.6 million shares floating around as of April of 2025. This number is useful for calculating earnings per share, something we will check later on. Let's dive into those numbers. As of March of 2025, they had about $456 million in cash. Looking at some key figures, their accounts receivable, that's money owed to them, was roughly $2.2 billion. Their liabilities totaled at about $4.6 billion. But let's see if they actually profited at all during the quarter. Okay, so for the 3 months ending in March of 2025, revenue came in at $9.4 billion. That might seem like a lot, but it's a drop from the $10.9 billion they made during the same billion dollar, 20% to be exact. Here is the big one. They actually lost money. A net loss of $21, that is a pretty big swing compared to a net income of $27.4 million the previous year. That means that on every share of stock, they lost $0.374 million the previous year. But hey, let's look at the cash flow statement because that paints a slightly better picture. They actually brought in $114 million from their day-to-day operations. It is definitely not all bad news. Financing activities, that's where they deal with debt and equity, used up $32.4 million. So overall, their cash went up by around $73.5 million. The report mentions that they keep a close eye on their customers' ability to pay. Bad debts are a risk when you extend credit. They do put aside money to cover some of these losses, around $23 million. Most of their invoices, around 95%, are paid within 60 days, so they are usually quick with it. Now, for something interesting, in April 2025, so right after this report covers, they sold off their UK land fuels business, Watson Fuels, and expect to take a roughly $65 million loss as a result. Back in 2024, they sold another part of the business, the Avinode Disposal Group, which actually gave them a $96 million boost. So it's clear they're actively reshuffling what they own, keeping what works, and selling off the rest. These folks use financial tools called derivatives to hedge against risks, and these contracts help them deal with price swings in commodities, currencies, and interest rates. Looking at how these derivatives are valued, you'll see level 1, level 2, and level 3 inputs. Level 1 is the most straightforward, like prices you see on the stock market, while level 3 involves more guesswork. Most of their stuff is level 2. Speaking of risk, there are clauses where they might need to put up collateral, basically cash, if their credit rating goes down. As of March 2025, that amount could have been $44 million. They measure the fair value of things based on what they could sell them for today. A few million in assets was identified as non-recoverable, and they lost a pretty hefty chunk of money, about $44.5 million, due to this from the sale of Watson Fuels. They use something called Slayer finance programs. Basically, they have arrangements to pay their suppliers later, and that number was around $129 million. They've got a fair bit of debt, including some convertible notes, debt, and finance leases. They also have a credit line they can tap into as needed. Let's peek at their tax situation. For the first 3 months of 2025, they saw an income tax benefit, but it is important to keep in mind there is high uncertainty surrounding these estimates. Remember that cost management? They spent roughly $15 million on restructuring in the first quarter, mainly on employee severance. But this could save about $30 million per year as those roles are eliminated, so they might end up saving money in the long term from this change. They measure reportable revenue based on 3 categories: aviation, land, and marine, with $2.4 billion, $2.9 billion, and $800 million in assets respectively. Lastly, there's a note about one of their directors setting up a trading plan. This is a pre-arranged plan to buy or sell company shares, often used to avoid insider trading accusations, so nothing too concerning. So what is my take on all of this? WorldConnect seems to be going through a lot of changes right now, selling off parts of the business, restructuring, and facing a tough market for energy. Their revenue is down, and that loss this quarter isn't pretty, but their plan to cut costs might help them down the line. They have some debt. They also have a manageable derivative system and are clearly focused on trimming the fat to make it as effective as possible. For investors, I would say there might be some short-term turbulence, but they might be able to ride it out. It all depends on what the market does. Thanks for watching Corporate Decoder. If you enjoyed, make sure to like, comment, and subscribe for more in-depth dives into the world of finance.